Following the crash of 2007-2008, a lot of blame was placed on financial regulators and central bankers, yet they seem to have increased their power in the years since the crash. What did the central bankers do that was wrong, and what alternative course of action could be taken?
Well, the central banks have gotten at least as much credit as blame for the recent crisis. It's true that they're held blameworthy for not having regulated strictly enough, but they're also given a lot of credit for their positive actions during the crisis, and I think that that credit is actually not well deserved. I think they actually made the crisis far worse by their interventions, particularly in 2008, than it would have been otherwise.
Could we imagine a world without central banks at all?
Yes, we can imagine a world without central banks simply by looking at past experiences that give us examples of such a world, of countries that had no central banks. And there have been examples of such countries right up into the 20th century, in fact.
And those examples would include?
Well, the most well-known and well-studied ones are the Scottish banking system up to about the middle of the 19th century, and the Canadian banking system from the period roughly 1860 or 70 until World War I, or if you like, even until 1935, which is when Canada finally established a central bank, though not because its previous system had proven defective. Those are the best known examples.
And were the financial systems stable, especially in Canada in the 20th century, which is the most recent example?
They were, and it's sad to say, these systems were notoriously stable. They were famously stable. The Scottish system, during its heyday, was the envy of all English people who went through crisis after crisis while noticing that the crises that afflicted them so badly were entirely escaped in Scotland, that the Scottish banking system managed to maintain stability at times when the English system, with its Bank of England supposedly providing an extra pillar of stability, in fact experiencing much greater instability. And that was exactly the same case applied in the United States, where the Canadians seem to have licked the problem of monetary and banking instability, even as in the United States, which also, of course, had no central bank until 1914, suffered crisis after crisis. The difference between the US and the Canadian system was something other than the lack of central banking. And I would argue, and I think it can be shown, that the difference was that the US system was much more heavily regulated, and the regulations were themselves very harmful.
So how does a system without central banks manage to maintain stability? We assume that central banks are necessary to control monetary policy, to keep inflation low on the one hand, and on the other hand to provide liquidity to a system and to regulate capital in order to ensure that banks don't fail, and if they do fail, the system stays afloat.
Of course, any banking system that's well run and stable is regulated somehow. The question is whether market mechanisms can provide the necessary regulation. When we talk about free banking systems of the past, including both the Canadian and the Scottish system, we have to remember that those systems, like all other banking systems at that time, ultimately rested on precious metal standards, on the gold standard or perhaps the silver standard, depending on what era we're talking about. So the ultimate regulatory mechanism consisted of the scarcity of gold, the worldwide scarcity of gold or silver, and the particular amount of gold reserves available in particular countries, which would be determined by the balance of trade among these countries. So this was a regulatory mechanism. It was also the regulatory mechanism in countries that had central banks. So the real question is, what further regulatory mechanisms were present in those cases where there were no central banks that could supplement the actions of the gold standard in regulating the overall behavior of money and credit? And the simple answer to what the extra mechanism was The one-word answer is competition.
And in the modern world, we don't just look to central banks to provide financial stability, but also to provide price stability. Now, that was provided through the gold standard in the free banking period in Scotland and in Canada. How would a free banking system without central banks maintain price stability in the 21st century?
Well, let's talk about price stability under the gold standard first, because the gold standard was the ultimate regulator of price movements, both in free banking systems and in less free ones, like those of the United States and England in the 19th century. But on the whole, the gold standard managed the price level relatively well. It provided for long-run price level stability. That is, over very long periods, you could expect the price level to come back to wherever it had been in the first place. But in shorter periods, which could last decades, you had some deflation, as in the last decades of the 19th century. But this deflation was mild, and it tended to reflect productivity gains or falling costs of production. And so, in general, it was benevolent. It was certainly harmless if it wasn't a good thing. It's important to distinguish the behavior of the price level over the long run with short-run episodes of deflation, such as occurred in the US and in England whenever there was a crisis. But those episodes didn't occur in systems like Scotland's and Canada's, where the financial banking system itself was stable, and so those systems did not allow that sort of bad deflation that happens when the financial system itself collapses. So you had good deflation in Canada and Scotland. You had good and occasionally also bad deflation in England and in the United States, traceable to bad regulatory interventions in those systems, including the central bank's misconduct in the case of England.
If we had a world without central banks in the 21st century, moving forward, would we return to the gold standard, or would there be some other anchor for price stability?
Well, if we wanted to have a world without central banks today, we would have to either restore some kind of commodity standard, or we would have to settle for getting rid of central banks, not quite completely, but mostly, by getting rid of their discretionary power to manage the ultimate monetary standards of the nations in question. So let me put that a different way. If you have a fiat money standard, as all countries do today, and you want to keep that standard, you don't want to go back to convertibility to gold, something has to keep the fiat money supply scarce. Something has to regulate it, and there's no natural way of regulating the supply of a fiat money. It has to be artificially regulated. We can do that, of course, with a discretionary central bank. That's what we've been doing. We can also, though, do it by imposing a rule on a central bank. And if the rule is strict, and if we set it up so that it maintains itself, as with a computer running the money supply process, something Milton Friedman recommended long ago, but it's even more possible now, then we are retaining sort of the rump of a central bank, but only so, because that's the minimum we have to have if we're to have a supply of basic money that is limited in some fashion.